Hi, it's Peter Schiff. This is Monday, January 21st, 2010. Well, today Barack Obama announced in a press conference that I happened to catch that he was going to be introducing new regulation into the banking industry to try to separate some of the risky proprietary trading, the hedge funds, the private equity deals being done by banks that are also working with insured deposits. And the regulation is meant to try to prevent banks from taking too much risk with those insured deposits. Now, the president got a number of things wrong when he announced this program. First of all, he said that the economic crisis, the financial crisis, was caused by greedy bankers who were trying to make a quick buck, and that these regulations will prevent the next crisis. Well, once again, the president is wrong. That isn't what caused the crisis. The crisis basically caused bankers to be able to act on their greed because of what the government did. What he is describing is one of the symptoms of what the real crisis was. The crisis was that the Federal Reserve irresponsibly lowered interest rates to 1%. The crisis was that Fannie Mae and Freddie Mac were guaranteeing mortgages that individuals couldn't repay. The crisis was everything that the government did to interfere with the free market that created the real estate bubble, that made the collapse inevitable, and that made possible all the rampant speculation on Wall Street and on Main Street. And the president is doing nothing to address the underlying cause of the financial crisis. The Federal Reserve is acting more irresponsibly than ever. The government is intruding into the free market more than ever. The government is even more involved in the housing market. The government is providing bigger moral hazards, not only to the housing market, but to the financial industry with all their bailouts and the idea that firms are too big to fail. So the underlying causes of the financial crisis are intact. And so not only is Barack Obama not protecting or preventing the next crisis, he's ensuring the next crisis, and he's ensuring that it will be even greater than the previous one. But let's actually look at what the president is attempting to do, because in a way, he's on the right track, but not totally. The president is very right to be concerned about the risks that banks take with insured deposits. But the problem is not that they're taking risks. The problem is that those deposits were insured in the first place. You see, the reason that banks can be so reckless with the money that they have on deposit is because the depositors don't care. They don't care what kind of risks the banks take because the government has already told them that their deposits are guaranteed. So who cares what the banks do? Now, if the government hadn't insured those deposits, the banks couldn't take all these risks because their depositors wouldn't allow it. They'd withdraw their money. So because the government came in and interfered with the free market by insuring bank deposits, it created a moral hazard for both the depositors and the deposit-taking institutions. And so now we need government regulation to undo the damage caused by government regulation. So this is not a free market problem. This is a problem that never would have existed in the free market. It only existed because the government came in and prevented the free market from working and created a moral hazard. So we do need to do things. But you know, the whole crazy thing about this is it was the government that convinced many of these firms to become banks. Goldman Sachs wasn't a bank until it converted to be a bank. Why did it become a bank? Because so it can get money from the Fed, so it can borrow from the discount window. So here you had a company that had no insured deposits that only has them now because they wanted to get bailed out. Now, of course, a company like Goldman Sachs might be able to go back to become an investment bank and no longer be a bank, right? And then, of course, when it gets into trouble again, it'll just do the same thing, so it can get bailed out. You remember you had the same situation with Bank of America that now bought out Merrill Lynch and now all of a sudden put all those deposits at risk because Bank of America took on all the liabilities of Merrill Lynch at the urging of the government, almost at gunpoint. That shotgun marriage was arranged. Now here you have the government saying we don't want them to do what they created in the first place. I mean, the whole thing is ridiculous. Yes, we do need some regulation on banks because the government removed market regulation. But what the government is doing is not the right way to go about it. There are much better ways to go about it. Of course, we would never have been in this mess had we not insured those bank deposits in the first place. But of course, much of the losses were not in those insured institutions. These losses happened outside those institutions. They happened in Freddie Mae and Fannie Mac, and they happened in financial institutions that were not operating with government guarantees. The principal cause of the problem and what remains unaddressed was the reckless monetary policy of the Federal Reserve that are even more reckless now, and the moral hazards created by government, by subsidies, by guarantees, and those subsidies, those guarantees are even bigger now. So the moral hazards are bigger. So again, Barack Obama has ensured that the next financial crisis will be even greater than the last. And of course, when he said that our financial system is more solvent now than it was a year ago, again, he's got it wrong. It's not more solvent, it's less solvent. It's on government life support right now because the Federal Reserve is keeping interest rates artificially low and has all the toxic assets on its balance sheet instead of on the bank's balance sheet where they should be. The minute this Fed stimulus is removed, the minute interest rates rise, the minute the Fed tries to unwind these positions, all these banks are going to fail again. And they're going to have even bigger losses than the last time. Now, the other thing I wanted to comment on is what's going on in China. You know, the Chinese have been talking about tightening up on their monetary policy, increasing interest rates, increasing requirements on banks to restrict lending. The initial result of that has been weakness in stock markets around the world and strength of the dollar. And there's some people that think that this dollar strength is a permanent shift, something meaningful. I think it's just a bunch of market noise. The fact that the dollar is gaining strength based on tighter monetary policy in China makes no sense. Long term, that is very dollar negative. Now, if the U.S. was going to match the tighter monetary policies in China, then maybe you can argue for a short-term rally in the dollar. But the reality is we're not going to match those increases. So as interest rates go up in China, that makes the RMB more competitive. That's going to accelerate the flow of money into the RMB to earn those higher interest rates, and that's going to put more downward pressure on the U.S. dollar. In addition, if the Chinese monetary authorities aren't expanding money supply as rapidly, then they're not going to have to buy as many treasuries, which means the Federal Reserve is probably going to step up and pick up the slack, which means more money printed in this country, which means a weaker dollar. So people who are jumping to the conclusion that what's happening in China is somehow bullish for the dollar are missing the boat. They're jumping to the wrong conclusion. There might be a short-term bounce in the dollar because of all the speculative money in there, all the hot money that's trading based on chart patterns. But the reality is what's happening in China is a big negative for the U.S. dollar, and people need to understand that and tune out all the noise. Anyway, that's it for today. I'll be back again soon. Have a great day, everybody. I'm off to another Republican town meeting this evening, this time in Ridgefield. Anyway, take care.